WallStreetBets has seen quite an influx of new paupers these days, and with the market's erratic behavior driving the average retail investor to the welfare line, these neophyte indigents are probably seeing a few terms on our subreddit that they haven't heard before. If you want to hang out with us, you'd better be able to talk the talk. So here's the second chapter in the WallStreetBets Dictionary of Degeneracy, featuring 10 critical terms. New guys, let's get you learning. First phrase up is long-term investment. For our purposes on WallStreetBets, a long-term investment is a short-term investment that failed. It's pretty common for actual investors to buy dividend stocks and benefit from stock growth over many years. That's normal long-term investing. I think there are like 4 people on WallStreetBets that do that, and they just lurk, they don't post. So if you see a WSBer talk about his long-term investments, you can be pretty confident that he tried to buy space when it was going up, only to get shanked the next day with a big loss. Said trader can avoid crying himself to sleep at night by pretending he's a long-term investor who believes that Virgin Galactic is going to the rings of Uranus instead of a failed day trader. This shuttles us right to the next term, iron hands. Iron hands is when you start losing money in a position, but you keep holding it anyway because you expect the trade to turn around and become profitable. This generally goes one of 2 ways. If it actually is a good trade, you'll obviously make money and you can claim your iron hands paid off. The other way is you keep losing money until you're down 90% and your iron hands are rusty and covered in poop. This second category is much more popular. People in this second category will also start yelling diamond hands because diamonds are harder than iron. But what they don't realize is that they are just common folk who can't fit into their gauntlets. You must use iron hands intelligently. You wouldn't wear iron gauntlets to play dodgeball. So likewise, don't use iron hands to ride JCPenney into the ground. Wear gauntlets when you need them. But when you're on a sinking ship, ditch those iron hands before you wind up underwater. They'll only weigh you down. Contrast iron hands with our next term, paper hands. Paper hands is a term that refers to selling at the first sign of loss. One of the universal truths in the market is that you are almost definitely not buying at the very bottom or shorting at the very top. When you enter a position, you are almost guaranteed to be down at some point, with exceptions in only a few very specific circumstances. If you have paper hands, you're going to see that 0.5% loss and think you made a bad trade, bail out, and then watch the stock go back up. Congratulations, you played yourself with your paper hands. If you have paper hands, a good strategy is to place a trade and then close Robinhood while the market does its little dance around your entry price. But can most people do that? No. We watch every penny like buffoons. Switching gears a little bit, let's talk about a term you've been hearing a lot lately, the Plunge Protection Team, or PPT, which bears have been mad at for like 3 weeks now. Those of us that actually have jobs might see PPT and think of the abbreviation for PowerPoint, but you won't find this PPT at your HR department's weekly meeting. In fact, the Plunge Protection Team is the staff that the president calls in for underground huddles to figure out how to stop the market from crashing during rough times. It sounds like a lame conspiracy theory, but it actually is a real thing. Created in early 1988, when the current bull gang president Ronald Reagan was really ticked that Black Monday happened on his watch, the PPT actively intervenes in the markets to make sure your puts always expire worthless. The Plunge Protection Team is led by the Secretary of the Treasury, currently Stevie Mnuchin, and consists of Federal Reserve governors, SEC folks, currency managers, bond villains, and Illuminati alumni. This group's job is to figure out how to stop SPY from plunging 5% a day. Most recently, the PPT decided to restock its printers and get this money printed. This carries us nicely into our next term, the infamous brrrr. Or if you speak Spanish, brrrr. Brrrr is the sound an overused printer makes when you need to print $6 trillion before anyone realizes it's a bad idea. This is a reference to the Federal Reserve's response to the recession stemming from coronavirus, which, as we just talked about, is basically to print as much money as possible using all available printers in 24-hour shifts at maximum speed settings. 6.6 million new unemployment claims this week? Doesn't matter. Stocks only go up because printer goes brrrr. International Monetary Fund stating that we will absolutely see a devastating global recession this year, stocks go up because brrrr. Until those printers jam or overheat, stocks only go up, and bears die mad. With all this brrrr going on, we are seeing a new term spring up, Trump bucks, also called Donnie dollars. Trump bucks are a free check that you can dump into your brokerage account to gamble on FDs using Donald Trump's money. Most of the money the Fed is dishing out in stimulus is going to bail out big companies like American Airlines, who spent all decade buying back their own stock while charging its clients an extra $40 to pick a seat. However, the little guys like you and I are also getting a couple of crumbs drizzled in mango salsa. Most adults in the US are getting $1,200 from the Big Cheeto, fresh off of J-Pow's printers. Or, if you're married, you and your spouse will get $2,400 together. And for the low price of having a kid, you can get another $500 tacked on, up to a total of $3,000 Or in other words, you get a $500 ROI on your first kid, and then a $100 ROI on your second. Trump bucks are supposed to help the plebeian class get by, but those of us on WallStreetBets are more likely to throw them down on SPY 210 puts expiring next week, because these printers have to jam eventually. Of course, Donnie dollars are not for rich people, because DJ Whitehouse already has their votes. If you made over $75,000 in 2019 as a single guy, or $150,000 as a family man, you will get 5 fewer Trump bucks for every $100 you made over that amount. So if you made over $99,000 as a bachelor, or $198,000 with a wife and kids, you are too rich to receive this bribe. But I guess they'll send you a $10 check if you made $98,800, whatever. But by and large, if you're really making bread, you'll have to gamble your own money instead. Let's switch jackets and talk about something a little more market related for our next term, the dead cat bounce. Think about the last time you threw a dead cat straight down at the ground as hard as you could. It bounced, didn't it? That's the concept we're exploring here. Throw anything down hard enough, and it'll bounce back up a little bit. This applies to stocks as well. When stocks take a nasty enough beating, buyers come into the market and start trying to put Humpty Dumpty together again. As a result, these purchases start pushing shares back up. On a stock chart, you'll see a little blip followed by more downside in a true dead cat bounce. Lots of bears these days are calling the market's 50% recovery since the March crash a dead cat bounce, but I don't know about you guys. Cats usually only bounce about 5 to 10% before they go back down. Unless this cat is made of rubber, something else might be driving this rebound. And that driver, my friends, is related to our next term, priced in. When an event is priced in, that means the market has already digested that information and stocks have already reacted to it before the event happens. So for example, if the market fully expects that in 3 months, Disney will release a bangin'-ass Luke Cage versus John Cena movie that will bring in $3 billion, Disney stock will react to those earnings as soon as that expectation is expressed, not necessarily when the real numbers hit the books. Thus, Luke Cage versus John Cena earnings are priced in. Noobs would see that the movie is slated for release on June 10th, so they'll buy calls on June 9th, thinking they'll profit from the movie's big premiere when everyone gets excited about its record-breaking numbers at the box office. But the multi-billion-dollar box office isn't going to move Disney when it's discovered that the movie did in fact earn $3 billion. That result was already priced in. Now consider our current economy. A month ago, we were hitting circuit breakers daily, the S&P 500 dropped 34% in a month in anticipation of death and destruction, Donald Trump headbutted the drywall. The market was literally pricing in an apocalypse. When jobless numbers came out and investors discovered we were only losing 20 million jobs a month instead of the priced-in number of about 65 million, the market was pleased. Likewise, when people started dying by the tens of thousands instead of the hundreds of thousands, investors started buying. The recorded economic data was not as bad as what was priced in. And since we had priced in the four horsemen, then according to the market, if we ignore the global pandemic and on-deck crushing recession, then there was nothing but clear skies ahead. We've got a sea of green in front of us, and we all want a piece of that action. This brings us right to our next term, a concept which is driving the market right now, FOMO. And if you don't know what FOMO means, I assume you're at least in your mid-40s. For those boomers and Gen Xers in the group, FOMO is the fear of missing out, and it is dangerous. When it comes down to it, we all want a good entry on our stocks. When you see people who don't really know what a leap is making $80,000 on SPY calls, the typical WSBer wants a piece of that pie, and we really don't want the market running away without us. So what do? We buy SPY calls from the guys who just made a bag on them and are ready to cash out. That purchase, based specifically on not wanting to miss the rush, is caused by FOMO, the fear of missing out. FOMO also drives itself as people start buying higher and higher priced assets in fear that they would miss the rush otherwise, and it crushes people who are on the wrong side of the market. And right now, who are those folks getting crushed? Bear Gang. Bear Gang is the class of traders who take bets that stocks will go down. Out of the past 52 weeks, they've made money in about 4 of them. But that's not to say they're total idiots. In those 4 weeks when SPY was dropping to circuit breaker levels each day, those bears grew so fat and happy that the numbers on the screen started to lose meaning. I can't even count how many bear gangsters made like 250 grand on SPY 190 puts only to see it melt off when JPow's printers and FOMO kicked in. Half of these guys have accounts shaped like the castle from Frozen, as their bearish accounts flew during the crash only to burn down like the Hindenburg during the subsequent rebound. Such is the life of a bear. Feast, famine, then return to hibernation. Bears, when you're ready, we will welcome you to Theta Gang with open arms. To those of you who are new to Wall Street Bets, I say this: welcome. Beer is in the fridge. For those of you getting destroyed by JPow's money printer, I advise that you take heart, for the measure of a person lies not in what one does in the easiest situations, but rather in how one acts in the most hopeless of circumstances. Well, that's it for this entry into the Dictionary of Degenerates. I hope you guys enjoyed this video, and I look forward to your posts and everyone's favorite sub. I hope to see you all next time. Happy trading.